Things are heating up as Bitcoin has entered the latter phase of its bull run. From October to now, the coin has been rallying upward to new heights, the fastest and longest running the market has seen in the past decade. And now the market is in a frenzy.
How the entire cryptocurrency system is going to collapse. It's the ultimate demise.
Just this month, Bitcoin went from $56,000 on April the 8th to $64,000 the following week. 4 days later, it was back to $54,000. Governments have been actively cracking down on crypto and are starting to make big decisions, like Turkey's recent ultimatum of banning cryptocurrency payments for goods and services. Investors are treading on a tightrope and are starting to decide on the next course of action because their investments are on the line, and you might be affected as well. Amid all this chaos, there are also fears over a Bitcoin liquidity crisis, as the volatility isn't stopping institutional interest from entering the market. Bitcoin has stirred up plenty of speculation over the larger economy, but let's focus on the liquidity crisis.
The world's richest man now investing $1.5 billion worth of his company's money in the cryptocurrency.
Recently, the coin has been getting a ton of attention from big names, like Elon Musk and PayPal. While institutional interest is good in driving up Bitcoin's market value, it's also putting the coin in a risky position. As more companies are hodling their coins in cold storage and treating them as long-term investments, there's less Bitcoin available in circulation, reducing its overall liquidity. Cryptocurrency liquidity stands for how easy it is to move a coin from one user to another. For example, if you go to an exchange now and decide to buy Bitcoin, all you have to do is click buy, and you receive 1 Bitcoin for approximately $54,000. Now, remember that extra fees play into the equation, and that value differs between exchanges. Sometimes a price slippage can occur, changing the actual buy price from the amount you were supposed to pay. This happens when the price changes between the moment you click buy and the time you complete the transaction. During a liquidity crisis, the demand for Bitcoin exceeds its supply, making it harder for you to buy and sell the asset. Illiquidity, or the lack of liquidation, will result in more price slippages and hidden fees when purchasing from an exchange because of how difficult it is to process the transaction, given the low supply. If the fees are too high, you lose motivation to participate in the crypto market, creating a domino effect that ends with very low trading volumes. A report conducted by Glassnode in 2020 found that 78% of the Bitcoin supply, or about 14.8 million coins, is illiquid. These are held by big institutions and independent investors, illustrating an ironic situation where an increase in mainstream Bitcoin interest is causing more pitfalls, rather than helping the crypto economy grow. But why can't Bitcoin just increase its supply? The reason for that is because Bitcoin was coded to have a maximum supply of 21 million, creating a sense of scarcity that investors are attracted to. You can earn Bitcoin through mining, but the reward is halved approximately every 4 years. That means that as time passes by, even less Bitcoin is entering the already scarce market, creating the perfect scenario for a liquidation crisis. An ideal solution to the looming liquidation crisis is for the financial sector to start encouraging investors like you to trade Bitcoin. Rather than stashing all your coins in storage, you should be incentivized to buy and sell goods and services with Bitcoin. As more Bitcoin is being traded, it becomes more liquid and less volatile.